This is a check from Silicon Valley Bank. I don't think it's going to clear. What's up, YouTube? Welcome to the Credit Plug channel. So in today's video, I'm going to be sharing with you how I lost tens of thousands of dollars from Silicon Valley Bank. And we're going to be going over the collapse of one of the largest financial institutions in the United States and one of the largest financial collapses in U.S. history. One of the largest bank collapse in U.S. history just happened. So for those who aren't familiar with Silicon Valley Bank, now Silicon Valley Bank is a financial institution that was really for businesses, particularly tech startups. And, before we get into the video, I just wanted to, let everyone know if you are affected by this collapse, our thoughts are definitely with you. Silicon Valley Bank is for, mostly tech startups. So this isn't like a bank that, any regular person or business can just sign up for. You have to become a client. Now, let's get into what exactly happened, right? So you've probably been seeing this all across social media, how the second biggest bank collapse in U.S. history happened in 48 hours. There was a downward spiral that began late Wednesday when Silicon Valley Bank surprised investors with news that it needed to raise $2.25 billion to shore up its balance sheets. And this basically caused what's called, a bank run. So a bank run is basically when everyone is trying to withdraw their money at the same time. And so customers withdrew a staggering $42 billion of deposits by the end of Thursday, according to a California regulatory filing. So that's a lot of money withdrawn in a very short period. Now, one of the biggest problems with this are customers who remain with Silicon Valley Bank face an uncertain timeline for retrieving their money because the bank is now insolvent, meaning that it doesn't have enough funds to fulfill the deposits. Regulators shuttered Silicon Valley Friday and seized its deposits in the largest U.S. banking failure since the 2008 financial crisis and the second largest ever. The company's downward spiral began late Wednesday when it surprised investors with news that it needed to raise $2.25 billion to shore up its balance sheets. So that's a huge amount just to come out as surprise, right? $2.25 billion. Just think about that. That's $1 million 2,250 times, just the way I think of it. So saying that they needed to raise that amount of money to shore up its balance sheets. So when news of this came, that's when the bank run began. And again, the customers of Silicon Valley Bank, again, are going to be a lot of the tech startups or tech companies, right? That's really who they marketed towards. So a lot of those companies start to withdraw their funds. And I'm going to go in later in the video how I'm actually personally affected by that because a lot of my business partners who are other tech companies, fintech companies, have been affected by this as well. So what followed was the rapid collapse of a highly respected bank that had grown alongside its technology clients. Now, this is a photo that was taken on Friday outside of Silicon Valley Bank headquarters. The episode is the latest fallout from the Federal Reserve's actions to stem inflation with its most aggressive rate hiking campaign in 4 decades. The ramifications can be far-reaching with concerns that startups may be unable to pay employees in coming days. Venture investors may struggle to raise funds, and an already battered sector could face a deeper melee. Now, right here is a graphic of Silicon Valley Bank stock, which has basically plummeted since the news of the bank run. The roots of Silicon Valley's collapse stem from dislocation spurred by higher rates. As startup clients withdrew deposits to keep their companies afloat in a chilly environment for IPOs and private fundraising, Silicon Valley found itself short on capital. It had been forced to sell all of its available for-sale bonds at a $1.8 billion loss, the bank said late Wednesday. The sudden need for fresh capital coming on the heels of the collapse of a crypto-focused Silvergate Bank sparked another wave of deposit withdrawals Thursday as VCs instructed their portfolio companies to move funds, according to people with knowledge of the matter. The concern a bank run at Silicon Valley Bank could pose an existential threat to startups who couldn't tap their deposits. All told, customers withdrew a staggering $42 billion in deposits by the end of Thursday, according to California regulatory filing. By the close of the business day, Silicon Valley Bank had a negative cash balance of $958 million, according to the filing. The precipitous deposit withdrawal has caused the bank to be incapable of paying its obligations as they come due. The bank is now insolvent. All right, so here are my thoughts on this. So this is actually something that I thought could be possible, right? Because, I'm very in tune with a lot of fintech startups. And one of the things that's happened recently, some of you guys, may have noticed this as well. Since interest rates have gone up, it's been more challenging for a lot of these startup tech companies to be able to raise money, and the cost of capital has just increased. And so I've seen this recently where, a lot of these startup types of fintech companies or tech companies have started to scale back because it's been harder to raise funds due to the regulatory environment, higher interest rates, and it just makes operations much more expensive. So what's happened, a lot of these companies have tapped into their deposits. Now, I actually partner with a handful of companies that actually bank with Silicon Valley Bank. As a matter of fact, right here, I do have a check from Silicon Valley Bank, and haven't cashed it yet. So I don't think it's actually going to clear. But I've seen this recently with a lot of companies, and I'll name a few where, they really just started to scale back as interest rates start to increase. And we've seen this a lot. I would say even as far as like marketing budgets for a lot of these tech or fintech companies, they've definitely dialed it back over the past couple of months, with some companies even reducing their fees or commissions that they pay out to acquire new customers and things like that. I've seen this a lot. Others who might be in the personal finance space could probably attest to this as well. A lot of these companies have scaled back. You have companies like Sable, which had the secure credit card. Now they're no longer accepting applications. You have other fintechs like Onu, which I did a review on. You check their website out right now, it seems like they fell off the face of the planet. So I think the interest rate environment has put a lot of pressure on a lot of these tech companies. Now, one of the unfortunate things about a lot of the customers that banked with Silicon Valley Bank, so these are going to be a lot of businesses. And so a lot of their deposits are only insured up to the $250,000 FDIC insurance. But, if you're a tech company with, millions or even tens of millions of dollars in the bank, is going to be a drop in the bucket. So that's where I think a lot of these customers are actually going to, be in a lot of trouble too. And right now, a lot of them are probably going to struggle to be able to make payroll because either, they didn't get their funds out in time enough, and now the bank's insolvent and they're not able to make those withdrawals. Now, how am I directly affected by this? Now, I don't bank with Silicon Valley Bank. However, a lot of business partners that I work with bank with Silicon Valley Bank. I'm not going to say a lot of the partners, but I could say maybe like two that I can think of off the top of my head where, they would pay me monthly, and their bank was Silicon Valley Bank. But yeah, it's very interesting what's going on right now and how, you had, I think they said the 12th largest bank in the United States just collapsed in 48 hours. So that's basically my take on the situation. I think that, the current regulatory environments, interest rate pressures have definitely, put a lot of businesses and a lot of financial institutions under pressure. And I'm not 100% certain that this is going to be the last bank collapse that we're going to hear about in the near future, because this is just one of the first ones where we're starting to see some of the cracks. So now, if you are someone who keeps your money in financial institutions, it might be a good practice just to spread your money around to different institutions so you don't have all of your eggs in one basket in case of something like this, where let's say you had a couple million in the bank and you're only insured up to 250,000. So it's good to have multiple different financial institutions. And I think this is, just a cautionary tale of, what could happen, given certain economic, financial pressures, witnessing one of the, I think they said 12th largest bank. Don't quote me on that. I think I saw that somewhere. But seeing this bank collapse is definitely unsettling, right? Because a lot of us, when we're putting our money in, our life savings or, whatever amount of funds, capital into a financial institution, we want to have faith that those funds are going to be available when we need them. I definitely feel for those, companies out there who may not have been able to get their funds out, or, they have a large amount of their funds that were uninsured. So it'll be a long road to seeing, what can be salvaged. Now, in my opinion, here's what I think happened and what probably caused this bank run at Silicon Valley Bank. Now, again, Silicon Valley Bank caters to tech companies, startup companies, and the venture capital community, right? And so with some of the latest interest rate hikes, it's made raising money for a lot of these tech companies much more challenging. And since a lot of these companies probably couldn't raise money, they probably had to dip into their own reserves. And so what we probably saw was a lot of these companies then going back into their bank and withdrawing more money instead, because they're unable to raise more money from outside investors or from different financial institutions because the cost of capital has increased. Also, a lot of the capital has dried up in the venture capital space. And I've seen this even with a lot of fintech organizations where they've just continuously cut back, right? Cutting back on marketing budget, cutting back on operations, firing and laying off people. And so a lot of these companies were under pressure. So instead of being able to go out and secure additional capital, a lot of these companies, I think, probably went into their reserves and drew down on their reserves. So when you have, as a whole, a lot of these tech companies drawing down on their own deposits, that may cause deposits overall to decrease, especially at a bank like Silicon Valley Bank, which caters specifically to one segment, right? So specifically tech companies. They don't really cater to any other types of businesses, mainly just tech companies. So if, the tech industry as a whole is, cutting back, or the cost of capital is increasing their operations, and these companies are having to draw down on their deposits. Silicon Valley also provides funding and capital to a lot of these companies. So if a lot of these companies are failing or unable to repay their debt obligations, or maybe even if Silicon Valley Bank overextended itself in lending to a lot of these tech companies that face a lot of these challenges, then you're going to get losses across the board. And I think that's what happened. Again, this is my opinion. There's really no, evidence besides just some of the anecdotal things that I've noticed just from working with a lot of fintech organizations. A lot of them recently have cut a lot of their budgets. Some projects that have been completely scrapped due to certain firms not being able to secure additional capital. Now, one thing you guys have to understand is that a lot of these tech startups, they thrive off of cheap capital, right? Being able to continuously raise, new rounds of funding, new rounds of capital. And when that becomes more challenging in a, ever increasing interest rate environment, then that's going to affect a lot of these businesses, right? Whether or not they exist or not. And I think the interest rate environment has definitely put a lot of pressure, especially on these, venture-backed tech companies, because if they're unable to raise money, or if, investors are unwilling to, continue to, pile money into a lot of these companies, which, for years may not even turn a profit, that just overall creates a lot of problems. So that's what I think, based on some of the anecdotal evidence that I've seen. Again, this is just my opinion, not any expert advice or anything like that. I've seen it in the financial tech space. A lot of these fintech companies, you guys have even seen it. But that's basically my take on the whole situation. Let me know your comments and questions right down below. And until next time, take it easy, and we'll talk to you soon. Peace.